Tonight, Walmart has agreed to pay $5.6 million to settle a lawsuit for overcharging customers. The lawsuit claims a retailer overcharged customers in 4 California counties.
A sudden shift in where people spend their money can break more than a shopping habit. When a large group stops crossing a border to buy goods, the ripple hits many places. In this script, Canada's shoppers turn away from the United States. The outcome is painful for some American retailers. Stores with thin margins and cross-border foot traffic feel the pinch first. Others struggle with inventory, returns, and public relations headaches. The scene that follows describes 15 retailers that find themselves in deep trouble. Each heading names a company. The paragraphs explain why the company is exposed and what trouble looks like in simple, clear language. Walmart. Walmart depends on volume. It makes money by selling many items at low prices. When Canadian shoppers stop driving to U.S. stores, volume drops. The stores near the border feel the change fastest. Sales in everyday categories like groceries and household goods fall. Low-margin items lose the most when traffic falls. Managers scramble to clear extra stock. Local managers cut hours and delay expansion plans. Suppliers face slower reorder cycles. Walmart's brand of always low prices looks weaker when aisles fill with unsold items. That hurts earnings and confidence. Target. Target built a reputation on trend-led stylish basics. Many Canadians liked hunting for exclusive items and seasonal finds at Target. With cross-border traffic gone, specialty departments weaken. Clothing and home decor see fewer impulse purchases. Stores that once enjoyed full parking lots now look sparse. Target's marketing team has to rethink promotions and markdowns. Merchandise that was supposed to be seasonal sits longer on shelves. The cost of clearances eats into profits. In short, Target's formula for fun, affordable shopping gets harder to execute. Costco. Costco relies on bulk buying and membership loyalty. Many Canadians used U.S. warehouse locations to fill carts for big gatherings. When they stop, the U.S. locations near the border lose high-value customers. Large pallet-ready items pile up. The membership model loses some of its shine if savings disappear. Managers face a difficult choice: raise prices or accept smaller margins. Both options risk further alienating members. The warehouse's logistics team must juggle oversized shipments with fewer takers. For Costco, lost cross-border demand means slower inventory turns and a tougher membership pitch. Home Depot. Home Depot's business is tied to home projects and remodeling. Homeowners often cross the border for specific tools and bulk building supplies. Without that traffic, specialty departments face a slowdown. Seasonal spikes, spring gardening and summer building, become muted. Pro customers who relied on U.S. pricing look elsewhere or delay projects. Contractors push back orders and reduce the size of purchases. Home Depot's regional distribution centers must absorb returned pallets and backlogged shipments. Inventory costs rise. The retailer faces a longer runway to recover margins. Lowe's. Lowe's competes directly with Home Depot on many fronts. It suffers similar problems when Canadians stop shopping south of the border. Product assortments planned for large projects no longer move as quickly. The retailer's pickup and delivery model starts to creak under altered demand. Smaller stores that relied on cross-border weekend traffic see significant declines. Marketing dollars that once paid for local promotions now focus on price matching or online offers. But online pickups only work if people still buy. When customers close the border in their minds, foot traffic becomes harder to win back. Best Buy. Best Buy was an anchor for electronic seekers and bargain hunters. Many Canadians like to compare models and snag deals in U.S. stores. With that habit ending, big-ticket electronics slow down. Televisions, laptops, and sound systems sit on shelves longer. Seasonal launches that depended on demo units and showroom traffic lose momentum. Sales staff are less busy, and conversion rates drop. Best Buy must rethink its promotions and price-matching strategy. Warranty and service revenue also suffer when fewer customers buy in-store. That weakens long-term profitability. Macy's. Macy's thrives on fashion seasons, holiday displays, and big sales events. Canadian shoppers were part of that rhythm. They wandered the floors, bought gifts, and chased doorbusters. When they stop, store-wide sales percentages drop. Inventory meant for holiday seasons stays longer on racks. Clearance events become more frequent, and markdowns deepen. Macy's must balance the brand's image with the reality of slower turnover. The company faces pressure to tighten buying strategies and rethink large format stores in border regions. Those decisions are costly and slow. Nordstrom. Nordstrom sells a higher touch retail experience. Shoppers came for service, quality, and curated collections. When Canadian cross-border shoppers step away, demand for premium footwear and designer pieces softens. Nordstrom's model relies on selling fewer, higher-margin items with strong service attached. Slower sales force teams to focus on promotions that dilute premium perception. Inventory becomes heavier in seasonal categories. The cost of returns and alterations rises relative to sales. For a retailer built on a white glove approach, the loss of these shoppers cuts at the core of the business model. Walgreens. Walgreens acts as a local pharmacy and convenience hub. The retailer sees daily foot traffic from quick purchases and prescriptions. Cross-border shopping played a smaller role for Walgreens than for big box stores. Still, certain border stores benefited from Canadians buying seasonal items, cosmetics, and over-the-counter drugs at scale. When that traffic ends, the stores with the heaviest reliance on cross-border customers see slower footfall. Pharmacy volumes are sticky, but front-of-store sales drop. Lower store revenue forces managers to rethink staffing and promotional investment in those locations. CVS faces a similar challenge. Pharmacy services remain vital, but the convenience and beauty aisles shrink when cross-border shoppers vanish. Promotional tie-ins and national brand promotions generate less noise in stores with fewer visitors. CVS may tighten its local ad spending and compress front-of-store assortments. Over time, even stable prescription revenue can't fully make up for lost impulse buys. Store-level profitability erodes, and the company must weigh which locations still make sense in a reshaped shopping map. Kroger. Kroger is a grocery giant with a strong regional footprint across the U.S. For stores near Canada, cross-border customers often filled carts with regional favorites and specialty items. When those shoppers stop coming, certain SKUs suddenly move less. Perishables life becomes a headache. Fresh foods that were meant to turn quickly now require deeper discounts. That adds waste and margin pain. Kroger's supply chain teams scramble to rebalance deliveries. Stores face choices: trim variety, which can upset local shoppers, or accept higher waste. Neither choice is good for margins. Dollar Tree. Dollar Tree relies on low prices and impulse purchases. Cross-border shoppers use these stores to stretch a dollar when making quick buys. Without that customer base, Dollar Tree sees slower transaction counts and smaller baskets. The retailer has long competed on convenience. When traffic drops, the balance shifts toward empty aisle space. Price-sensitive items pile up. Management must either broaden the offering or accept deeper discounts. Changing the product mix risks alienating loyal customers. Either way, the retailer faces tough decisions on how to keep stores profitable. TJX, TJ Maxx, Marshalls. TJX companies trade on treasure hunt shopping. Cross-border visitors loved the chase. Without them, merchandise moves slower. Seasonal buys intended to be quick hits instead sit on racks. The retailer's model of rapid turnover breaks down when one key customer group disappears. Buying teams must alter orders and slow future deliveries. That creates a knock-on effect with suppliers and distribution. Even the store's marketing message, "New finds every week," rings hollow when the foot traffic doesn't show. Lower sales per square foot hurt the bottom line. Gap Incorporated. Gap, Old Navy, Banana Republic. Gap's brands depend on consistent traffic and clear brand identities. Cross-border shoppers often supplemented local demand for basics and seasonal fashion. When that channel dries up, Gap stores face holes in revenue that promotions can't easily fill. Old Navy's family-friendly lines see slower sales. Banana Republic's higher-ticket items move less. Gap must either push deeper discounts or simplify assortments. Frequent sales can erode brand value over time. The company must also decide where to close underperforming stores. Those choices are expensive and can weaken customer loyalty. Amazon. Amazon is different from the rest because it is digital first. But the company still feels border shifts. Many Canadians shopped U.S. sellers on Amazon to find lower prices or faster availability. As they pull back, cross-border sellers see fewer orders. Third-party merchants dependent on U.S.-bound shoppers lose an important audience. The reduced demand can create an oversupply of certain goods. Fulfillment centers adjust shipments and storage patterns. Amazon's platform benefits from global scale, but pockets of sellers and categories may struggle. That weakness can ripple into delivery times and seller sentiment. The human cost. Behind the numbers are people. Store employees see fewer hours. Managers face harder choices about schedules and staffing. Warehouse workers confront slower shifts and altered pick lists. Small suppliers who relied on large orders from these retailers find their cash flow stretched. For communities near the border, the economic shock is visible. Restaurants and gas stations that fed cross-border customers suffer too. The pain is not just on spreadsheets. It is local and immediate. The strategic response. Retailers do not sit still. They cut local markdowns. They shift marketing to domestic audiences. Some try hyper-local assortments to serve nearby customers better. Others invest in online services and curbside pickup. Price matching and loyalty perks become louder. Retailers also review store footprints. Closing or repurposing stores is a last resort, but it often appears on the table. Those changes take time. In the short run, earnings and investor sentiment wobble. In the longer run, the winners are those who move fast and serve the new realities of buyer behavior. Why Canadians pulled back. The reason for a cross-border retreat is rarely simple. Sometimes politicians or tariffs change the math. Sometimes the currency moves against shoppers. Sometimes a string of bad experiences or travel pain pushes people to buy at home. Whatever the cause, the effect is the same. Fewer shopping trips, smaller baskets, and changed expectations. Retailers that assume those shoppers would always come are surprised. The ones that plan for volatility and diversify their customer base have a better chance of surviving. Short-term fixes and long-term shifts. Short-term fixes include promotions, targeted discounts, and replenishing fast-moving items. Stores try to clear aged inventory with big sales. They redesign displays to encourage quick buys. Longer-term shifts are harder. Retailers rethink sourcing to lower costs. They test smaller store formats. They build better loyalty programs aimed at local shoppers. E-commerce strategies expand to reach customers who no longer cross borders. Those moves help, but they require capital and patience. The PR problem. Public perception matters. Headlines that scream "in trouble" accelerate anxiety. Customers read, worry, and change habits. That makes the problem feel bigger than it is. Retailers must manage messages carefully. They highlight community ties, local jobs, and value. They avoid admitting long-term weakness in public. Still, when stores start to close or hours are cut, the story becomes real. The court of public opinion is fast, and retailers must act quickly to show movement and hope. What comes next? Not every retailer will fail. Some will adapt and find new customers. Some will shrink, refocus, and survive. Others may be forced to sell assets or close locations. The pattern depends on how severe and sustained the cross-border pullback is. If it is temporary, a smart response can blunt the hurt. If it lasts, structural change follows. For the 15 retailers named here, the path forward is a mix of damage control and reinvention. When shoppers change their minds, entire business models feel it. The 15 retailers in this script face different versions of the same problem. Lower foot traffic, slower inventory turns, deeper markdowns, tough choices about stores and staffing. The challenge is real, but it is not necessarily fatal. The retailers that move quickly, listen to customers, and realign operations will do better. The rest will struggle until reality forces a harder reset. In the end, retail is a conversation between buyer and seller. When one side withdraws, the other must respond, or else pay the price.